My topic is marketing trends in detail explain, and let's go to the topic and let's go to the start. A market trend is a tendency of financial markets to move in a particular direction over time. 1. These trends are classified as secular for long time frames, primary for medium time frames, and secondary for short time frames. 2. Traders identify market trends using technical analysis, a framework which characterizes market trends as predictable price tendencies within the market when price reaches support and resistance levels, varying over time. Trends begin by knowing the consumer's interests and needs. Market trends inform organizations about what products develop, for what customers, at what cost, through which distribution channels, reducing the uncertainty that a new product/service development always brings with it. Learn more in Competitive Intelligence and Technology. Watch from patent information to leverage innovation to external macro-environmental impacts that an organization has very little or no control over and are likely to affect the marketing in which a company operates. Learn more in Marketing Global Luxury Spa and Wellness Trends, Experiences, and Challenges. 3. Trends begin by knowing the consumer's interests and needs. Market trends inform organizations about what products develop, for what customers, at what cost, through which distribution channels, reducing the uncertainty that a new product/service development always brings with it. Market trends provide information on industry data. Market trends are analyzed by marketing teams to inform best practices and map marketing strategies. Market trends are influenced by the government, international transactions, and consumer behavior over a period of time to create fluctuations in trends. A market trend is anything that alters the market your company operates in. This could be something as far-reaching as artificial intelligence technology, as fickle as consumer preferences, or as industry-specific as new regulations. In fact, it's almost certain there are multiple market trends affecting your business at the same time, right now. Why is it important to keep up to date with industry trends and developments? Well, because that's how you grow and stay ahead of your competition. As author and motivational speaker John Maxwell once said, "Change is inevitable, but growth is optional." While you can't stop the momentum of change like technology or regulations, you can take steps to grow in tandem with those changes. This trend tracking doesn't have to add up to hours of research every week. By understanding the types of market trends, you can distinguish what makes sense for your business. This focused analysis helps you adapt and stay competitive in any rapidly changing business environment. If you try a simple Google search for market trends, you're likely to get a lot of information about stocks, financials, and investing. Today this term applies to many industries, but it does have its roots in finance. And though your industry of operation might be B2B services, retail, energy, technology, healthcare, or many other sectors of the economy, you can still learn from the 3 ways financial professionals think about a market trend. Digital marketing trends are key changes in the strategic direction of the digital marketing landscape, including the evolution of marketing techniques, consumer sentiments, and underlying technologies that impact the way marketers should interact with their target audience. Market trends are tendencies in markets, analyzed by companies, to better inform their business practices. Explore examples of market trend analysis through customer needs, technology advancements, and market demographics. Market trend analysis. Imagine that the first cell phone has just been released. People are excited and confused by the idea of carrying a phone outside of their home. Few people have cell phones, and some are uncertain that they will become popular. Fast forward 20 years and the streets are dominated by cell phones. A couple years later, the smartphone takes over. Take a look around you today. There are smartphones, tablets, and even watches that allow you to make phone calls. This change in the communication market is an excellent example of a market trend. A market trend is anything that alters the market your company operates in. In order to keep your company ahead of the competition, it is important to utilize market trend analysis, or the process of evaluating changes to your market. Market trend analysis looks at how your industry started in the market, how it has grown, and where it is expected to go. For example, how cell phones first come about, how their popularity changed, and how manufacturers and retailers expect the market to change. In market trend analysis, you will want to look at several trends relevant to your organization. Consider the phone industry. The market trends in technology, changes to customer needs, and communication trends are likely important trends to analyze. Other market trends that may be important or influential to your business include changes to your market demographics and changes in the economy. If you only look at technology, you might miss important information on customer needs and interests. Also, if you only look at the economy, you might not be considering the trends that are relevant and important for your business. Each trend will affect your organization in various ways, so you want to be sure to look at the trends that are relevant, and consider more than one trend. Let's look at 3 trends up close and see how they can affect your business. Customer needs and interests. When you conduct a market trend analysis, you want to consider the needs and interests of your consumers. For example, as technology advanced, so did cell phones. As cell phones advanced, so did the needs and interests of the customers. On the other hand, if you don't continue to meet the needs and interests of your customers, you will be left in the dust as they move on to the products they desire. Consider that the cell phone is now used for email, Facebook, Skype, and various other methods of communication. Because of these market changes, the phone industry is constantly looking for new ways to meet the needs and interests of their consumers. Phones are becoming smaller and easier to carry. They now have cameras, alarms, schedule books, and some are even able to turn the lights off in your home. Market analysis allows the phone industry to understand the psyche of their consumers, and thus, they are able to make the phone fit the daily needs and interests of the people who want to buy the products. Leave the oven on at home? No problem, your cell phone can turn it off. By analyzing the current and future needs and interests of your customers, you can ensure your products and services are cutting edge. Technological advancements. Technology changes can be extremely important to any market you operate in. If you are in the phone business, the development of glass technology, waterproof technology, internet, and camera technology are all important to your industry. However, even if you sell coffee, the harvesting, transportation, and roasting of the coffee can be influenced by technology. In accounting, advanced computer systems via technology affect your daily operation. Market trend is the asset's price direction over a given period. Market trends apply to all assets and markets such as foreign exchange, commodities, stocks and bonds, where prices and trading volumes fluctuate. Yet, what is a market trend exactly, and how can you make the trend your friend? Here we take a look at the market trend definition and how it can inform your trading strategy. Market trend is defined as the asset's price direction over a given period. An asset or a market that experiences an overall price increase over a certain period is said to be in an uptrend or a bull market. When an asset's price moves into a series of lower highs and lower lows, it's said to be in a downtrend or bear market. Market trends help traders and investors in identifying trading opportunities. Market trend is the direction of the asset's price over time. In technical analysis, when prices experience a series of higher highs and higher lows, they are said to be in an uptrend, which is often referred to as the bull market. In contrast, prices are said to be in a downtrend when they suffer through consistent lower highs and lower lows, known as the bear market. Market trends help traders in identifying potential shifts in the market that they can speculate on. This article is about market trend in finance. For the trend of a market that is used in a company's planning activities, especially regarding inventory decisions, purchasing, facility expansion and promotional activities, see market analysis. A market trend is a perceived tendency of financial markets to move in a particular direction over time. Analysts classify these trends as secular for long time frames, primary for medium time frames, and secondary for short time frames. 2. Traders attempt to identify market trends using technical analysis, a framework which characterizes market trends as predictable price tendencies within the market when price reaches support and resistance levels, varying over time. A market trend can only be determined in hindsight, since at any time prices in the future are not known. The terms bull market and bear market describe upward and downward market trends, respectively, and can be used to describe either the market as a whole or specific sectors and securities. The terms come from London's Exchange Alley in the early 18th century, where traders who engaged in naked short selling were called bearskin jobbers because they sold a bear's skin, the shares, before catching the bear. This was simplified to bears, while traders who bought shares on credit were called bulls. The latter term might have originated by analogy to bear baiting and bull baiting, two animal fighting sports of the time. Thomas Mortimer recorded both terms in his 1761 book Every Man His Own Broker. He remarked that bulls who bought in excess of present demand might be seen wandering among brokers' offices moaning for a buyer, while bears rushed about devouring any shares they could find to close their short positions. An unrelated folk etymology supposes that the terms refer to a bear clawing downward to attack and a bull bucking upward with its horns. A secular market trend is a long-term trend that lasts 5 to 25 years and consists of a series of primary trends. A secular bear market consists of smaller bull markets and larger bear markets. A secular bull market consists of larger bull markets and smaller bear markets. A bull market is a period of generally rising prices. The start of a bull market is marked by widespread pessimism. This point is when the crowd is the most bearish. The feeling of despondency changes to hope, optimism, and eventually euphoria. As the bull runs its course, this often leads the economic cycle, for example in a full recession, or earlier. A bear market is a general decline in the stock market over a period of time. It includes a transition from high investor optimism to widespread investor fear and pessimism. One generally accepted measure of a bear market is a price decline of 20% or more over at least a 2-month period. A smaller decline of 10 to 20% is considered a correction. Bear markets end when stocks recover, attaining new highs. 13. The bear market, then, is measured retrospectively from the recent highs to the lowest closing price, and its recovery period is the lowest closing price to new highs. Another commonly accepted end to a bear market is indices gaining of 20% from their low. A market top, or market high, is usually not a dramatic event. The market has simply reached the highest point that it will, for some time. Weasel words, usually a few years citation needed. It is identified retrospectively, as market participants are not aware of it at the time it happens. Thus prices subsequently fall, either slowly or more rapidly. William O'Neill reported that, since the 1950s, a market top is characterized by 3 to 5 distribution days in a major stock market index occurring within a relatively short period of time. Distribution is a decline in price with higher volume than the preceding session. A market bottom is a trend reversal, the end of a market downturn, and the beginning of an upward moving trend, bull market. It is very difficult to identify a bottom, referred to as bottom picking, before it passes. The upturn following a decline may be short-lived and prices might resume their decline. This would bring a loss for the investor who purchased stocks during a misperceived or false market bottom. Baron Rothschild is said to have advised that the best time to buy is when there is blood in the streets, i.e., when the markets have fallen drastically and investor sentiment is extremely negative. Similarly, a bear market rally, sometimes called sucker's rally or dead cat bounce, is a price increase of 5% or more before prices fall again. 23. Bear market rallies occurred in the Dow Jones Industrial Average Index after the Wall Street crash of 1929, leading down to the market bottom in 1932, and throughout the late 1960s and early 1970s. The Japanese Nikkei 225 has had several bear market rallies between the 1980s and 2011s, while experiencing an overall long-term downward trend. The price of assets such as stocks is set by supply and demand. By definition, the market balances buyers and sellers, so it is impossible to have more buyers than sellers or vice versa, although that is a common expression. In a surge in demand, the buyers will increase the price they are willing to pay, while the sellers will increase the price they wish to receive. In a surge in supply, the opposite happens. Supply and demand are varied when investors try to shift allocation of their investments between asset types. For example, at one time, investors may wish to move money from government bonds to tech stocks, but they will only succeed if somebody else is willing to buy government bonds from them. At another time, they may try to move money from tech stocks to government bonds. In each case, this will affect the price of both types of assets. Ideally, investors would wish to use market timing to buy low and sell high, but they may end up buying high and selling low. Contrarian investors and traders attempt to fade the investors' actions, buy when they are selling, sell when they are buying. A time when most investors are selling stocks is known as distribution, while a time when most investors are buying stocks is known as accumulation. According to standard theory, a decrease in price will result in less supply and more demand, while an increase in price will do the opposite. This works well for most assets, but it often works in reverse for stocks due to the mistake many investors make of buying high in a state of euphoria and selling low in a state of fear or panic as a result of the herding instinct. In case an increase in price causes an increase in demand, or a decrease in price causes an increase in supply, this destroys the expected negative feedback loop and prices will be unstable. 25. This can be seen in a bubble or crash. Market sentiment is a contrarian stock market indicator. When an extremely high proportion of investors express a bearish, negative, sentiment, some analysts consider it to be a strong signal that a market bottom may be near. 26. David Hirschlife foresees in the trend phenomenon a path starting with underreaction and ending in overreaction by investors-traders. Indicators that measure investor sentiment may include Investor Intelligence Sentiment Index. If the bull-bear spread, percent of bulls minus percent of bears, is close to a historic low, it may signal a bottom. Typically, the number of bears surveyed would exceed the number of bulls. However, if the number of bulls is at an extreme high and the number of bears is at an extreme low, historically, a market top may have occurred or is close to occurring. This contrarian measure is more reliable for its coincidental timing at market lows than tops. American Association of Individual Investors, AAII, sentiment indicator. Many feel that the majority of the decline has already occurred once this indicator gives a reading of -15% or below. Other sentiment indicators include the Nova-Ursa ratio, the short interest/total market float, and the put/call ratio. Government policy. Using fiscal and monetary policy, governments can slow or accelerate the growth of market trends. For example, adjusting a central bank's interest rate could affect a country's economic growth, having a direct impact on cyclical and defensive sectors. Market sentiment. Market trends can be shaped by the sentiment among market participants. When traders and investors have faith in the direction of a country's economy or a company's business outlook, their optimistic attitude can shape a bullish trend. On the contrary, a negative market sentiment among traders can push the asset's price lower. Supply and demand. The asset price tends to fluctuate following shifts in dynamics between supply and demand. This is especially relevant for commodities. For example, when the economy is booming, demand for crude oil rises, oil prices tend to rise. Wars and mining disruptions restrict supply, therefore too boosting the prices. Corporate and economics news. Upbeat results in company quarterly reports or positive economic readings that beat expectations can all contribute to an uptrend. On the contrary, negative news could push prices lower, creating a downtrend. Short-term trends occur over a few hours or days. In marketing or business positioning, this would include news and current events, social media trends, or sales events like Amazon Prime Day and Black Friday. For example, if a news story breaks that is relevant to your business, you need to create content about that quickly to capture interest before it ebbs away. Intermediate trends last anywhere from 2 to 8 weeks. In finance, these are rallies and turnarounds that can mystify analysts. In business, causes of intermediate trends can be easier to pinpoint, but not always. Events like the holiday season, elections, tax time, or industry-specific compliance deadlines represent some factors that can drive intermediate market trends. Maybe your competitors do something every year to mark some of these occasions, or your customers are looking for unique products or services for a few months. Other times, social media influencers or emerging research drives these trends and interest. Long-term trends last years and even decades. These are big societal changes that affect your business, like mobile devices and artificial intelligence, gaps or deficiencies in the talent pipeline, the COVID-19 pandemic, and culture shifts like the Me Too movement or demands for racial equity and justice. While you might need to adapt to the new environment as these long-term trends manifest, responses should be more thoughtful than reactionary. For instance, just because you know consumers want a mobile-friendly experience doesn't mean you should implement one without strategy. Short and sweet video marketing. While video watching hit an all-time high in 2020, forecasts estimate that adults will spend approximately 80 minutes per day watching digital videos on mobile devices by 2023. One of the best ways to get them to watch and engage with your videos is by keeping them short. Reddit took this to an extreme during the 2021 Super Bowl, buying a 5-second commercial slot as a part of a brand awareness campaign. It worked, and the tweet link to the video has racked up over 464,000 views. Pillar-based marketing content still remains one of the most effective ways to get your audience's attention. Pillar-based marketing is a strategy that builds authority, pushing your content further up the rankings on search engine results pages. Sharing our own win with pillar-based marketing, we published 6 pieces of content per week for 3 weeks around the topic of SEO keyword research. There are lots of trends that matter to different consumers at different times. But if your business tries to be everything to everyone, your message won't speak to your ideal customer over all the others. Focusing on short-term market trends might be one way to make customers aware of you through social media or Google results. But it's how you speak to long-term trends and show your value that will take them from casual reader to dedicated customer. There are a few ways you can find out about the market trends affecting your business. As you explore these trends, it's also important to be asking critical questions about how your values and service offerings align, fit in, or even run counter to the trends. Building better relationships with customers. When you know who your customers are and what they are searching for, you can create a marketing plan that will better attract them and keep them once they are customers. Creating competition. You want to keep up with the competition, and analyzing marketing trends allows you to do so. What is your competition doing well? What could they be doing better? Look at those areas and determine what your business can do to remain competitive. Supporting business growth. When you look at marketing trends, you can determine where your business can develop new products and services to attract new customers. Identifying areas for improvement. What could your business do better? Look at marketing trends to determine what those areas might be and improve upon them. Avoiding crises. The unexpected happens all the time. When you look at marketing trends, you can start to predict what might cause problems for your business before you actually face those problems. Driving sales. Ultimately, all of these points lead to one big benefit for your business: an increase in sales. Once you figure out what your customers want and how to give it to them, then hopefully you can improve the financial well-being of your business via increased sales. Thank you for watching the video and subscribe the channel.